right, everybody. This is Tarek Musa. We are going to get things kicked off with today's Investor Power Hour. Appreciate you joining us today for another one of our Investor Power Hours. These are our monthly events where we basically provide a bunch of education and knowledge and a forum for folks to ask questions related to investments or real estate or anything related to the topic directly or peripherally. For this month's Investor Power Hour, we are joined by our CFO and guest, Deborah Pritchard. She is a tax accountant extraordinaire. She's very humble, so she won't say those things, but I will give her credit where it's due and uh, hype her up a little more than she's willing to. But she is an expert when it comes to tax, anything related to tax, really, but especially as it relates to investments in real estate. She is an investor with us. She has been in the real estate game specifically for a long time and knows all the tricks of the trade and kind of the nuances that maybe a lot of folks out there don't know. It's not just a matter of taking information and putting it into a tax filing. Anyone can do that, right? That's just clerical work, really. But from a tax strategy standpoint, understanding what should be done, when, and how, and where, that's where the magic comes into play, and that's where Deborah really shines. So with that, she has a presentation set up for today that she's going to run us through, and I'm going to let her take it from this point on. Welcome, Deborah. Morning.
Thanks, Tarek. You're always so gracious. I can tell everybody that I've been working for Disrupt since November of 22. Prior to that, I was a tax partner and real estate was my thing. I've been investing in real estate since 2008 in syndications. And that was actually, if you remember, that's when we couldn't even get leverage. We had to put together partnerships to buy an apartment building. And if we could stabilize it, then we were able to put debt on it, like refinance, pull all of our equity out and start the process over. So since 2008, when I got involved in partnerships, I've been tracking my basis. And it starts with that initial investment. So I'm going to share my screen and we're just going to go through a short presentation. You can put your questions in the chat if we don't get to all of your questions, because we had some beforehand, and we will download them and I will answer all those questions for you. So I'm going to share my screen.
Real quick on that topic. Yes, everybody who's in the meeting, please, there at the bottom of your screen in the Zoom window, there is a Q&A button. Go ahead and click in Q&A and go ahead and enter your questions there, and we will be sure to get them addressed. Thank you.
So Tarek, I don't see where it says share my screen. So how can I actually share my screen? Oh, there it is. I see. I've got it. Okay, let me see. It says sharing is not turned on. I've sent you a request.
All right, you should be approved now.
Okay. Okay, so everybody should be able to see my screen now. And this is just going to be, a presentation. I mean, there's just so much information here and I could get so deep, and I love tax. So if you have any questions, please send them. But this is just going to be a guide to monitoring your tax basis and pass-through entities, specifically as it relates to getting into a real estate syndication. I've got a real life example. I've got one of my K1s from start to finish in here. I invested in it in 24 and it was foreclosed. I invested it in 21 and it foreclosed in 24. So we're going to look at how those K1s manifested and what it looked like. Let's see. Reasons why you should track your basis is it helps you to determine how much of a loss you can deduct, if your distribution is going to be tax-free, if you'll have a gain or a loss upon your sale. And basically, the IRS requires it, and proper tax reporting. Form 7203 for individuals, that's actually if you're getting a K1 from an S Corp. Tax basis, so it starts with your initial investment in the partnership. We call that cash contributed, or perhaps in another deal, like maybe you had contributed the building that's being renovated or something. And then we adjust that annually for income and loss allocations, distributions, or any additional contributions. Capital calls would be an additional contribution. So key adjustments to our basis. A K1 basically is the partner's share of the current year income, deduction credits, and other items. So we would increase our basis by our share of income, any contributions, and allocated liabilities. And when we get to the K1, we will look at section K, which is the partner's share of liabilities. They're divided into non-recourse, qualified non-recourse, and recourse. And in real estate, the qualified non-recourse gives us basis to take distributions and losses. That's not always true in every partnership, so you really need to have a tax advisor. And I'm just going to say one more time, this is not tax advice because everybody's situation is different. You need to have a really good tax advisor and planner so you can use all this stuff so that reduces your taxes. We decrease basis by any distributions that we get, losses. So if the apartment building is generating a loss, and any non-deductible expenses. So what we really want to see on a K1 is we want to see a big loss in box 2, and in box 19 we want to see a big positive number because that means we're getting distributions and the property is cash flowing. Well, I shouldn't say it doesn't always mean it's cash flowing. We just hope it's cash flowing and they're not actually giving us distributions from our original capital contributions. But that's why we would be looking at the financials on a monthly basis. So I just wanted to show you boxes 1 through 11 are our income items on a K1. Box 2, as you can see, is net rental real estate income. All of these things are the things that we would typically increase our basis by, but if box 2 is negative, it's going to decrease our basis. Boxes, and then we get to box 12 through 18. Those are actually deductions from basis. Box 19 is going to be where distributions come in. So annual tracking, and after this, the next slide is going to be how I track my basis, but this is how I started. I started with my beginning basis, and this is just on an Excel spreadsheet. I added my contributions and my income. I subtracted losses and distributions. I adjusted it for liabilities, but I didn't actually adjust it on my Excel spreadsheet because I didn't need to, and I will explain to you why. You calculate ending basis and you keep repeating that. So this is my Excel spreadsheet. I'm going to jump down to the first K1. And I apologize that it's a little skewed, but this was the first K1 that for this investment in this 3390 Fairburn. I invested, as you can see, my contribution is right here. I invested $100,000 in 2021. The first year, I got a loss of $63,311. There was nothing else on the K1. Box 20 is usually other information that is used in other calculations possibly. So it doesn't actually affect my basis. So if I go back to the spreadsheet, you can see there's my initial contribution of 100,000. There's my income in box 2, which was a negative. So that left a capital account of $36,689. Over in another column, I was tracking my suspended losses because I was passive in this deal. I couldn't deduct any of these losses unless I had other passive income. So I tracked my suspended losses. Then came along, 2022, and no contributions. You can see that the 36,689, that beginning account, is going to balance to what was on my spreadsheet. And I got a loss that year of $20,343. So going back to my spreadsheet, here's my beginning capital, 36,689. My income was 20,343, so that left me with a capital balance of tax capital balance of 16,346. And at this point, there's really no difference between book or tax. I put out into the other column my suspended loss because I'm still passive. And in 21 and 22, I didn't have any other deals selling, so my loss from this deal was still suspended. So we're going to go to 2023. And again, no capital contributions. There's my original 16,346. So this is one of the reasons you should be tracking your basis on an annual. They had this capital contributed during the year as a negative $607. Well, I knew that I hadn't contributed any capital. And when I checked the supplemental information on the K1, it said transferred capital. So I contacted the GP, and, said, this isn't me. I didn't transfer capital to anybody. So what is this? They realized it was a mistake. They had already filed this return and they told me they would fix it in 2024. So when we go to look at my 2024 tax return, they will have fixed it. But this is, sometimes there could be other increases or decreases. I always ask what these things are about because if I haven't done anything, there shouldn't be anything in those on those lines in the partner's capital account. So that 607, as I said, it said it was transferred capital. They transferred it to somebody else. And as I said, they had made a mistake. If I hadn't questioned it, I don't know that they would have found it. So when I went back and I put my sorry, I went too far. When I put my, I ended up the same capital count as them as 18,365, negative capital account. My suspended losses, they're 118,365. Now, at the end of the day, we can only deduct what we put into something. I can't deduct $118,365 in losses. So I knew that in 2024, they were going to have to allocate me at least $18,365 of income. So that it would bring me back down to my $100,000 loss. So my final K1 that I got from them, so I circled some things that are really important for you to look at when it's supposed to be a final year, because all of those suspended losses I had for the 118,000, they will not be released unless this final K1 at the top is checked. So they will still stay as suspended if that box isn't checked. I wanted to make sure that there was no ending debt in box K, because box K is where the debt is. If we go back to this 2023, the reason this $18,365 negative was not a taxable event for me is because if you look up in box K, there was qualified non-recourse financing allocated to me of $203,000. Now, so long as that number, because that actually gives me basis, remember. So if I add 203,684 and subtract 18,365, I still had positive basis because as I said, qualified non-recourse financing gives us basis to take distributions and losses. So my final K1, so that became zero. I started with my negative, and you can see I was allocated income, and there's the $607 that they fixed from the prior year. So I got $17,758 in income. If you add the 607, that's how we'd get to the 18,365. But 10,096 in box 2, probably some of that's recapture from 1245 property. In box 10, that is the sale. That's the other. It's the land, it's the building, it's other things that maybe there was no recapture on. But of the building, 3,718 is going to be like recapture on the building. It's going to be at the preferred tax rate at 25%. And you can see I've got this little $2 in non-deductible expenses. So if we go back to here's my final K1. I had a negative 18,365 capital account. I had income of 10,096 in box two. Box 10, I had 7,664. They gave me back my $607 and I had a $2 deduction. So my suspended losses, they started off at 118. I've got to add the income that comes in. Basically, on my 2024 tax return, I'm allowed to take $99,998 because I had $2 of non-deductible expenses. And those will come from penalties. 50%, only 50% of meals are deductible. So I always look at that as well and to see what it is that I'm paying for that I can't deduct at the end of the day. So this shows you how I got back to my original investment and how I would be deducting my original $100,000. But we'll go over this again. As I said, this final K1 has to be checked. I knew I was getting income and I knew it needed to be 18,365. If it had been more than that, then my capital account would not have come to zero. And so if you get a K1 and your capital, and it's a final K1 and your capital account's not to zero, you need to question whoever did that K1. Because I've had them, and if that doesn't come to zero, it means I've either been allocated too much income and somebody else didn't get allocated enough, or I wasn't allocated enough income and I still have a negative, capital account. So it's really important that whoever is doing your tax return understands these K1s when they get them for you. So it's important for the person preparing them to understand how they work, but it's also really important for you, your person, to understand how these work. So some of the best practices, as I said, you should always track your basis annually so that you can find things like this $607. Now, I've seen it where that's thousands of dollars. And, and I've had the accountant tell me that it was just a plug. And those are just not, those are things that I can't, then I want to, I want a much bigger explanation. So I review my K1 thoroughly each year to make sure that, there's lots of information that a K1 will tell us. I keep it as a supporting document with my basis, and that's what I send to my tax advisor. And together we coordinate because we'll look at, all passive losses offset passive income. So in this case, if I'd had in maybe 22 or 23, I had, I actually had a deal sell in 22, but I didn't need to use any of these suspended losses to offset the gain. I had enough other losses that offset that gain, so I didn't actually pay any tax on it. But if that had, this was a game that I used to play, I would, in 2020, we got, I don't know, 6 or 7 deals sold. We were looking to invest in other deals to get depreciation, these depreciation interests, to get these suspended losses such that they could offset all of those gains that I have because they were in the same year. So it's there's lots of planning that can be done if you have a really good tax advisor. That's why we say you want to track your basis annually, you want to review your K1s, you want to coordinate with your tax advisor. Those are just good practices to get into. And as I said, I just have always used a spreadsheet. It's the same thing, ending capital is your beginning capital for the next year. You add all those things in and, I knew as I said, before I even got my 24K1, that they would be allocating me $18,365 in income. And I've done this for other people. I've gone back, tracked their basis, and said, okay, this is what you're going to get allocated for income. Those things are important. I mean, if your losses are suspended, and all of this loss, the whole 118, as you could see in the last year, it becomes, I started off with that whole suspended loss of 118,000, added the income, and that's how I got back to my original basis. So at the end of the day, we're never going to be able to deduct more than we put in, but we should be able to deduct at least that. Now that's assuming I hadn't used any of these 118,365. I hadn't used any of those losses to offset other gains in other years. I also track that basis as well. And there's a form, an 8582, in your tax return that will also help you track that. So we had some questions come in. And so I've written the question down and I've, put a general answer in there. I've had one more question come in that I didn't get a chance to add to the presentation. But if you have questions, please put them in the chat and we'll answer them if we have time. And if not, we will certainly send the answers to you via email. So the first question I had was, when you inherit a share in a real estate syndication or an irrevocable trust with real estate in it, how do you value that for your basis? And the general rule is the basis of the property acquired from a decedent is stepped up or down to its fair market value at the date of death. So for a syndication, I'm going to say you should reach out to your GP and your tax advisor regarding an appraisal. Sometimes you don't need an official appraisal. The GP might be able to tell you what the current cap rate is and the net operating income to give you a value, and then it's your percentage. For a trust, you should always get a formal appraisal. And so I would reach out to the trustee, because usually the trustee of the trust is going to request a formal appraisal. So this was saying, does the syndication or the trust get the appraisals dated for the date of death? Most company agreements are going to tell you who would be responsible for that. Often in a syndication, it would be the person requesting it. That's why you would reach out to your GP and your tax advisor to see if they're fairly confident in what the current cap rate is, net operating income, and could you use that value versus getting an official appraisal. For a trust, you contact the trustee to see who's responsible, but for a trust, you always get an official appraisal done. You should always get an official appraisal done. If somebody asked why tracking their basis was important, we can only deduct losses up to our basis, and we'll pay tax on distributions that exceed our basis. And it's helpful to calculate your gain loss. So I can tell you for another deal that I was in, I got into the deal in 2013. We sold it at the end December of 2020. In that time, I had actually been refinanced out of it 3 times. So my original basis was 100. I got 300,000 in proceeds back as refinancing proceeds. Didn't pay any tax on it because I got allocated, as I said up here, I got allocated qualified non-recourse financing that gave me basis to take those distributions. So those numbers in that qualified non-recourse financing and recourse are all important. The other thing in a refinancing is the GPs still had not guaranteed any of the debt. As soon as the GPs guarantee the debt, I could have had a taxable event because I wouldn't have been allocated the qualified non-recourse financing to give me basis for those distributions. So that is something I would want to know. Is the debt being guaranteed or not guaranteed when a refinance is going on? Because it changes. If I've been using that qualified non-recourse to give me basis to take distributions and it goes away, that is an immediate taxable event for me. So here, like I said, you include both recourse and qualified non-recourse. They can increase your basis. They're treated differently. And recourse, I have to be the one guaranteeing it to actually be able to take it. But qualified non-recourse is usually in real estate because they use the building as the guarantee. So this was an example here. I was just saying I've invested 50,000, my share of the partnership liability. So in this line here, it would have say $100,000 as ending non-qualified non-recourse. And so that actually gives me a basis of 150,000. So I could deduct losses or get distributions up to 150,000. Now my losses may be suspended under the passive activity rules, so I still get them allocated, but as you can see, they sat over here in the suspended bucket, but they were still allocated to me because I had enough basis to be able to take them. So the passive activity loss rules mean, like we see a big loss on our K1, but I can't deduct it currently. It gets carried forward. And it gets carried forward until I either have passive income or I say I sell my interest in the partnership, or that means I get a final K1. A final K1 will release all passive losses on it. And if I have other passive income, it will also release those losses. This was how do I handle refinancing proceeds? Distributions from refinancing reduce your basis. So as I said earlier, it depends on whether you're going to get allocated qualified non-recourse financing. They may or may not be taxable. Mine were never taxable because I always got qualified non-recourse financing allocated to me. And um, basically in that we ended up making 8 times our investment in that deal. And because I was able to take the proceeds and invest in other deals, I didn't pay any tax on it. So, but that's because we did planning. I was planning, all along. I knew what I was going to get allocated in income. So I was planning, I was looking for other deals because we knew it was going to sell. And we had an approximate price. So I was planning all year long, looking for deals that I could invest in such that I wouldn't end up having to pay any tax. Somebody asked if they invested through a self-directed IRA or entity, the basis or rules apply to the entity. Same thing. And you may be subject to unrelated business income tax, and that's just on the leverage portion of the deal. And although we recalculate depreciation at straight line, over 5 years, you're going to get the same amount of depreciation as somebody who got it all in year one. So you definitely want depreciation even if you're investing through your IRA because it reduces your unrelated business income. So that's all the questions that I had. I don't know. So just to give a recap, general basis rules. I mean, it's your initial contribution. You add all income, any additional contributions, your share of the debt. You decrease it by losses, by distributions, and any non-deductible expenses. Some real estate specific things, depreciation reduces basis. Refinancing proceeds reduce basis, and depending on, they may be tax-free, maybe not. Distributions of property, we didn't talk about that, but those are different. Those would get handled much differently than if it was just cash. Inherited, you want to get a step up or a step down in basis based on the date of death value. If there's a step up, you would want to ask the partnership to do a 754 election because a 754 election will give you more depreciation. On that step up, they would actually figure out what the depreciation is on that, and it would get allocated to you. If they don't do a 754 election, because they're not going to do it unless you ask them, your gain at the end of the day will be the same, but you will get less deductions throughout the life. And if you're a real estate professional, that might make a difference to you. If you're not a real estate professional and they're suspended, it won't make a difference. So it's again another planning opportunity. So best practices, as I said, you always request your K1s, you track your basis annually, and you coordinate with your tax advisor and do some planning. Okay, Tarek, I don't know, did any other questions come in?
Yes, actually, Deborah, thanks for that. we did get a few questions, and anyone else who has questions, please shoot them in the Q&A box at the bottom of your screen. Just click that button and it should give you some places you can basically enter your question. Deborah, we got at least two questions right now live if you want to answer them. Is first one, with the new tax bill that was just passed, bonus depreciation is back up to 100%. Can you clarify if this will be phased out as before, or will this be permanent, at least under this law? Are you familiar with that, Deborah?
Yeah, I know that they made permanent year one is going to be 100%. I can't honestly say that I've looked at the phase out ranges after that, but is like they made permanent year one will be 100% because it would have gone back to like not, so I think yeah, so I'd have to revisit that. I do know it's back up to 100%. That's a big deal for me. It's a big, because especially if you're a real estate professional, as a real estate professional, it offsets all income because your losses no longer are subject to the passive activity rules. They become ordinary. But there can also be a catch-22 with that. We have some deals on a foreclosure deal like this deal here that I showed you of mine. The GPs had been allocated losses all along and had no base. They had qualified non-recourse to give them basis to take those losses on their tax return. But when the final K1, and that debt went away, I don't know, maybe they had 2 million in negative capital account. That 2 million was immediately taxable for them, and they would not have had any suspended losses to offset that. So the only way that they could offset that would be by getting into a new deal and getting new depreciation. And when it was down at, 40%, it wasn't going to give them enough depreciation. So now that it's back up to 100, it's possible they could offset some of those gains.
Yeah, thanks, Deborah.
Uh,
Yeah, so to kind of recover to rehash that, the key thing there is that right now with the latest bill, it is at 100% permanently for year one. So
mhm.
obviously, the term permanent is somewhat open to interpretation depending on future administrations and future Congress sessions, what they're ultimately going to do, because nothing's ever permanent in law because it can always be changed. But ultimately, right now, that is the basis that we're working on, and I think for the foreseeable future, that is probably what we're going to continue with. But that is obviously subject to the legislative sessions that may or may not change that in the future.
Yeah.
So thanks for that, Deborah. And then one more question we have is, and this one is basically asking, how should I go about finding a good CPA for all of this? Do you want to take that, Deborah, or do you want me to
Yeah, I was gonna say you go ahead because I mean, really, you need to find somebody who, as I said, that understands real estate. I think going to like networking and finding out who people are using as their CPA, because good real estate CPAs are overwhelmed because there aren't enough of them. But you go ahead, Tarek. You go ahead and you can answer more.
Yeah, look, I mean, this whole presentation ultimately is obviously subject to your individual personal situation. Everybody's situation is different. So there's that disclaimer that obviously comes along with any of these kind of presentations related to tax matters. But ultimately, if you are a real estate investor, then I encourage you to reach out to us. Shoot me an email at invest@disruptequity.com. Just let me know that you're looking for a good CPA who understands real estate. And there is a person who comes to mind that we recommend. We don't have any sort of commission or any of that sort of stuff. We don't get paid for this, but she's a rock star. She's awesome. Deborah's in touch with all the time. I think you know what I'm talking about, Deborah.
Mhm.
So you have not just the CPA's mind that you can tap into and leverage. Yeah, Deborah is a resource that they communicate on a regular basis with too, to kind of chat about this stuff and ultimately solve problems or solutions that may be needed, that maybe one person wants a second person that they can bounce ideas off of and so on. So to get that information, just shoot me an email at invest@disruptequity.com and I can get you their contact information, put you in touch that you can get that help that you're looking for. But that is really the best way to do it. Ultimately, referrals are the best way to get most industry related contacts. And in this case, obviously, we work with a ton of investors, a ton of CPAs, and so on. And there's someone that comes to mind specifically that I can recommend you to. So once again, that email is invest@disruptequity.com.
Yeah.
Okay. I think
And
those
and
are all the
and
questions right now. Did you want to add something else, Deborah?
what's that? I was going to say I was just going to add that I mean, it really isn't, there's, with the current, economic environment, it's really important to be tracking your K1s. We always get ours out by March 15th, but I can tell you that, I have investments with other syndicators because Disrupt didn't always have a deal going when I had money available. And the only K1s I have are ones that, from a CPA that we recommend and ours. All of the other deals, I'm still waiting for my K1s, but they're not selling or going into foreclosure as far as I know. So I can still do an estimate of what what my tax situation was in April. If they were going to sell, then I'd want to know, like, what are we selling for? The note, I'd want to be able to try and figure that out, and so I mean, if I couldn't do it myself, I would definitely be trying to engage somebody that could help me do that because it could make a difference in what I might have to pay April 15th. So it,
Yep, the best way to get ahead of these challenges, of course, to plan ahead and get ahead of them, right? So
yeah, yeah.
understood. So awesome. Well, Deborah, thank you very much for the time and for the presentation. Hopefully a lot of people kind of absorb this, got an idea about what it meant, makes sense. Again, if any of this is kind of maybe tough for you to understand and you think that it's stuff that you should be getting involved with, and maybe it's hard for you to track, then again, I encourage you to talk to your CPA, use your accountant. Put this on them to actually give you the help ultimately. Don't let them just be a data entry person. Let them actually help you strategically plan for your tax situation and your future finances. So with that, appreciate everyone's time again joining us
I'm
on
going to
another
say one more thing because it's not the partnership's responsibility to track your basis. It is up to you. And so, if you sell your interest, those are things that we have to know. But all we can do is, we put it, we will report that in the year that it happens. But it's still up to you because now maybe you've got outside basis. You might, because if the partnership doesn't do a 754 election, you are definitely going to have outside basis. So um, it's up to you and your CPA or your tax advisor to track it. It's not up to the partnership because they don't really know what else is going on outside of just that partnership.
Right, right. Awesome. Absolutely. All right, guys. Well,
Okay.
with that, once again, appreciate everyone's time for joining us for another Investor Power Hour. And we'll put these on once a month, like we said. And we encourage you to keep your eyes out for the next email that we will have for next month's Investor Power. And we look forward to seeing you then. All right. Thanks, guys. Thanks,
All right.
Deborah.
Bye. Bye.
Take care. Bye bye.